Hi, here we are this afternoon at the Wise Guru Q&A, and everyone's sent in some pretty interesting questions this week, again as usual. It's it's getting close to Christmas, so we're all on a hopeful rundown to Santa coming through, but there's no sign of him as yet. So when it comes to questions, I'm going to start with a few where we've had several people come up with similar questions, I suppose. And this first one's an interesting one. It's a client who said, look, as you know, I have pre-approval from the bank for $1.8 million. And okay, yes, certainly we know that. And what I'm thinking is that I'm going to buy an old house. I was looking for something that I could redevelop, but I realized that I probably am not going to find that. So I'm just going to buy an old house for now, and then perhaps look at buying a second new property in the new year somewhere when I find something that I like. And what do you think about that? So, great question. But as I have to remind people, we've got to think about how this all came to pass in the first instance. So how did we get that 1.8 million pre-approval for that client? And some of the things that we put in, obviously, that will determine how much money you can borrow are rental incomes, or expected rental incomes from the property or properties that you say to us that you wish to purchase. In this instance, this person had said, look, I want to buy 2 new properties where I'm not going to have much in the way of maintenance to pay out, and I also want to get a pretty high rental return, a good yield on those properties for now, because I'm still young, I'm starting out, and I want to make sure that I've got sufficient income coming in to pay for the interest and the outgoings just in case. You know, pretty good idea really, isn't it? Most people actually wouldn't mind doing something like that. So let's have a look and delve a bit further into this question though, because when this person came to me, they said, look, I want to maximize my borrowing capacity and I want to buy, say, 2 properties worth about $2.2 to $2.4 million. Terrific. So we did that. And the assumptions that we make around that is that each of those properties are going to get about $1,000 a week or 4.5% plus in rental income. Brilliant. Now let's take a step forward, if you like, and go into the rest of the question. If this person wanted to buy an old house now on perhaps larger land, what is going to happen? Well, one of the things that's really important when it comes from bank lending approvals is income. So I asked the question, I said, look, how much rent is this house going to get? He said, well, it's actually being rented out now and the tenants are paying $750 per week, and it's going to cost around $1.5 million. So now that really changes the complexion of this whole thing, doesn't it? Because all of a sudden, instead of getting roughly $2,000 a week rental income, we've got this new property at $1.5 million, giving us only $750 a week in rental income. So what's going to happen after that finishes? Well, we have to go and do the numbers. So when that person said to me, what do I think? It's hard to answer that up front, but let's have a look. $1.5 million for the property. We're going to be left with about $450,000 to $500,000 of borrowing capacity left after that. And that all sounds great. But if we then look at what we could buy for, say, $700,000 as a new property that's still giving us a 4.5% yield, we're going to find that we're going to be around $1,350 per week in rental income instead of the original $2,000. So the upshot of all of that is that the bank basically says, well, I'm sorry, but we're not going to lend you any more money. So what might have started off as a really good plan, someone saying, you know, I've got this approval, forgetting the assumptions that they've made to obtain that in the first instance, and then going off and doing something else, is not necessarily in its own right a bad thing. However, it is going to curtail their ability to borrow money and therefore to expand their investment property portfolio. So that's something that's really important, and people need to be cognizant of what's going on in this, and they need to actually sort of start making some pretty good macro choices about this. Because what would happen if we, say, turned this on its head and said, right, we've got this pre-approval for $1.8 million, and that's on a sort of basis of $2,000 a week rental income from these two properties. What if we said, first of all, we're going to buy one of those new rental properties that's going to give us roughly a 4.5% yield. So in that instance, say it's 1.2 million, and because you're a client of ours, you only need to put in 15%, so 180,000 plus stamp duty and costs. There's $1 million roughly of your borrowing capacity used up, and you've still got 800,000 left. And then you went to look for an older property that perhaps had some extra land with it or some extra features that you liked, and did it that way. That might be a far more pragmatic solution to achieving the same goal, except you are going to get a much better outcome, because you're then going to be able to borrow enough money to buy two properties. It's something that everyone needs to bear in mind. It depends on the cost of the various properties. So I'm just putting that forward as to something that people sometimes do because they think I've got a pre-approval and it's set in stone. It's not. It is fluid. It does depend on what you've put in there in terms of your assumptions. Particularly these days, banks are obviously going to look at income and expenses. So your expenses on a personal basis haven't changed much, but your income assumptions due to the lower yield have changed a lot. And then the other thing, of course, you need to bear in mind, if you're buying a house that's 100 years old, it is likely to have some repairs, some maintenance that you need to think about, because over a period of, say, 12 months, 24 months, that can be a relatively meaningful amount in terms of a percentage or reduction in the yield on that property on a net basis, because you might have to spend, let's say it's 1% on repairs and maintenance. So in its entirety, not a massive amount of money. It might be $10,000 or $15,000, but if you take that off the income, it can impact you. So these are all things that you need to think about. And that's why all these questions are terrific, because it makes us think about things, and hopefully I can convey that message so that people start making some, pragmatic choices. And everything might work well for you in the way you've worked it out, but you've got to think about what's the flip side of that coin. What does it look like once I've made that choice? Because clearly if you've gone and bought the old property for $1.5 million, you can't just flip that on its head and change that around. You have to keep that, you're going to have to work with that, and you're going to have to take some time to expand your horizon beyond that, if that makes sense. So that covers off, I guess, a lot of that. Happy to take any further questions that people may have on their own specific situations, or how that may impact them, or they've got some thoughts in place. They may have an existing approval from a bank, and just let us know, because at least we can spend the time to run through these things for you and make sure that perhaps you don't make a choice that will hinder you from doing something that you think you can anyway. Now, the second question or questions, we've had a lot of chatter recently in relation to these changes that are being brought in New South Wales in relation to discretionary trusts that own residential property. And the reason I just go over it again is because the drop dead date for amending an existing discretionary trustee is the 31st of December this year, 2020. So, less 3 weeks away. You haven't got a lot of time to make some changes. We've covered this in prior sessions, so I won't go through the whole body of this, but just important to know that if you've got a discretionary trust and it owns residential property in New South Wales, the Office of State Revenue, or Revenue New South Wales as it is now known, is going to consider your trust a foreign trust if the beneficiary, if you like, classes have not been amended to specifically exclude a foreign person. Now, you may or may not have a foreign beneficiary at the moment, and if you do not, it's important to look at your trust deed or have your lawyer look at your trust deed to see if it needs to be amended so that you don't fall foul of these provisions, because what's happening is Revenue New South Wales will then say, no amendment, trust deed can distribute to a foreign beneficiary. What's going to happen is you're going to pay the foreign person surcharge of 2% in land tax, and if that trust then goes to purchase a property, 8% transfer duty. So it's a reasonably significant amount of money, and I think it's very pertinent to know that you've got 3 weeks to potentially change that outcome, because after that it's going to get really difficult. So anyone that needs to know anything further about that, please contact your lawyers or contact us, and we can put you in touch with some of the panel legal practitioners that we work with, and they should be able to assist you. This is only for New South Wales at this present point in time, but it is really important, probably most important for those people who currently hold residential property through a discretionary trust. So if you've got a discretionary trust and it doesn't own residential property in New South Wales, and it may never own residential property in New South Wales, look, I still think it's a good idea to amend your trust deed so you don't have an issue later on. But clearly, if the other is already occurring, or you're in the process of purchasing some land or a house or investment property in the name of a trust now, definitely make sure that your lawyers review the trust deed and make sure that you're not in a position where you're going to get stung with this needless tax that Revenue New South Wales will levy upon the trustees of that trust. Also important to look at what other beneficiaries or classes of beneficiaries may exist, charities, maybe corporations. Some trustees say the corporation can be an Australian corporation or other. So lots of things to think about. Make sure that those amendments are put in place. They need to exclude foreign persons, and they also need to be irrevocable. So that's another important issue. So you can't then go and change it, because that would otherwise nullify what's going to happen. And anyone can go and have a look on it's revenue.newsouthwales.gov.au. There are examples there, there's more information there, but I'd suggest you get your lawyer to do this for you, because it is a pretty important situation going forward, and you're not going to be able to change it after New Year's Day. So that's the second one. And the third question for today, someone just asked me today, I've been quoted 4.88% interest rate for an Australian mortgage as a foreigner. This is a really tough question, and I often get questions similar to this where people just take a headline number and don't give you any context. So is this right? The answer is yes, certainly it can be. But you've got to look at the underlying fundamentals that are going to determine that interest rate. So, is it a principal and interest rate loan? Is it an interest-only loan? Is it a fixed loan? Is it a variable loan? What is the LVR, the loan-to-value ratio? Is it, 50%, 60%, 70%, 80%? Because there aren't many lenders that are going to lend to foreigners when they're buying Australian property as it is. And these lenders will tend to operate a bit differently to Australian banks in terms of what fees they charge. And they can do that, obviously, because they're acting as lenders in a very, if you like, niche market in a small space. But as a borrower, you need to ask yourself the question. So if someone says 4.88% to me, yes, we can do better than that as an interest rate. But you need to be asking yourself, what else is there that I need in that loan? Does it have flexibility? Does it have an offset account? Can it be changed? Is there a payout penalty? And some of these lenders will charge a risk fee, and that could vary between 1.25% and 3.5%. So, there's no good just throwing a headline number around. You've really got to look at what the overall situation looks like and come up with a good outcome. And of course, the other thing you've got to remember then, if you're a foreigner, you're buying an Australian property, and if you're looking for a headline number like that, you may also have forgotten that perhaps you're limited to buying a new property rather than an old property. You need Foreign Investment Review Board approval, FIRB approval, to buy an established property, and that's generally given to people who are foreigners and moving to Australia, going to obtain permanent residency, and many other things revolving around that. But they're legal questions, and we can look at that separately. So really important to think about that, because if you're a foreigner and you're going to buy a property, generally speaking, you'll buy a new dwelling, which would negate to some extent your imposts that are being established by FIRB and help facilitate that situation. As we all know, there are foreigners that buy properties in Australia, but you've got to do so within the guidelines and within the regulations as they exist. Otherwise, you're going to run into some pretty serious problems down the track if it progresses to that stage. So, as foreigners, let us know if you're looking to invest in Australian property. We can certainly help you in terms of the structure of loans, what you should be looking for, what you should be trying to avoid, and make sure you end up with a good outcome, rather than just focusing on the rate, because you can get the cheapest rate, may not be the best outcome, or you may pay more and may not be the best outcome too for that money. You've got to know what it is that you actually need in terms of the loan providing this, that, other benefits for you. So look, I think there's some of the important issues that we've been hearing a lot about lately. We've got Christmas coming up, so there may be a little bit of a hiatus in Q&As during that period of time, but that doesn't matter. Follow us on Facebook, Wise Guru, send us an email. We're very happy to come back to people and discuss with them any issues that pertain to their own particular situation. We can book a Zoom call, we can have a WhatsApp call, whatever you like, in relation to briefly sharing some information with you that might put you on the right track, or at least pointing you in the direction of professionals in certain areas that you should be consulting prior to actually taking any action. And at the end of the day, all of this is really about helping people take action, and I think that's a pretty pertinent thing now, because from what we've been looking at in property markets in Australia, we look at these on a weekly basis, they are doing exactly what we've been predicting from earlier in the year, from April onwards, and I believe that next year, 2021, that will continue. I can see the different property markets around Australia. The majority of those, if you're going to look at quality assets they're in, are going to keep rising. So the momentum, I think, has started to build a little, and I think that will continue to build. That'll be underpinned by ultra low interest rates, as we all know, and I think that will then put some more pressure on housing prices. So with that thought in mind, that's it for today. Hope you've enjoyed it, and I hope you can think of some really interesting questions for me again for the next Q&A, and we'll see you then. All the very best.